Hello students, in this video I am going to teach you the treatment of provision for tax. Provision for tax. Suppose in previous year the balance of provision for tax is given 50,000 and in current year it is given 60,000. If no any adjustment is given in the question, current year balance will be treated as provision made during the year. Provision made during the year. And it will be added back to the net profit in working note while calculating profit before tax. And the previous year balance will be treated as tax paid during the year. Tax paid during the year. And it will be deducted in cash flow from operating activities. So this is the treatment of provision for tax. We don't have to compare the both year balance, right? Suppose now if adjustment is given related to tax, suppose tax paid is given, in adjustment rupees 45,000. So we have to prepare provision for tax account in that case. So how to prepare provision for tax account? Started from credit side by balance brought down. Provision for tax is a liability. That's why the account of provision for tax will be started from the credit side. This is the opening balance. So record here 50,000. And this is the closing balance. To balance CD 60,000. Now the rule of liabilities account. If liability increases, we record here in the credit side. And if the liability decreases, we record here on the debit side. Now the adjustment is given that we have paid tax during the year. When we pay our liability will reduce. So income tax paid will be recorded here in the debit side. To cash account, income tax paid. And second time it will be recorded in cash flow from operating activities. 45,000. Now the total of debit side is 1,05,000 and the total of credit side is 50,000. The difference is provision for tax made during the year by statement of P&L. That means we have transferred 55,000 to the provision for tax account out of profits during the year. So this is also called provision for tax made, and this will be added in net profit in working note while calculating net profit before tax. If in adjustment provision made is given, the balancing figure will be income tax paid. So one of them will be missing figure, right? If the paid is given in adjustment, we will calculate provision made during the year. And if the provision made is given in the question, the balancing figure will be income tax paid. So this is the treatment of provision for tax in cash flow statement. Thank you.